Everyone, welcome to Sparta's Asia Pacific webinar, Charting the Course for Summer. My name is Samantha Hartke, and I'm the head of clean products at Sparta. While the first few months of this year was marked by a certain amount of bullishness, there has been a marked downturn in the markets, despite ongoing peak refinery maintenance in Asia. Near-term arb opportunities into Asia may be scant at the moment, but there are green shoots to be found this summer for the region. To that end, I will be joined by my colleagues Phillips Jones-Lux, James Noel-Beswick, Jorge Molinero, and Michael Ryan, who will present their views on what current dynamics portend for the crude, middle distillate, gasoline, naphtha, and freight markets in the coming months. After which we will have a Q&A session with all our commodity owners. And if you have a question, you can submit it via this platform. But first, for those of you who might be unfamiliar with Sparta provides real-time, actionable market intelligence. It is built by traders, for traders, and sets itself apart from data analytics providers by delivering forward-looking, actionable insights. How do we do it? We enable traders to identify the gap between price and value. Currently available for gasoline, distillate, jet, naphtha, and crude, we're bringing full barrel coverage to our clients, delivering a comprehensive cross-desk solution for insight and intelligence all in one platform. Most importantly, Sparta enables you to trade with conviction. So let's first kick things off with Phil, who will take us to the outlook for crude.
Welcome to the crude section of the webinar. We're still pretty new within Sparta on the crude side, but we are making progress already. So the product has been live for 2 months now, and we've been adding a number of different grades, a number of additional routes, with plans to add more refining hubs as well in the future. And we're already starting to see some pretty actionable and interesting insights coming out of the platform. The first of those in the last couple of weeks, in terms of the big moves that are relevant for the east of Suez region, would be the collapse in the EFS and how North Sea cash diffs have been collapsing and opening opportunities for those Atlantic Basin barrels to move into the east as and when demand returns there. So obviously we're going through refinery maintenance in the east at the moment, but crude buying kind of schedules should already be seeing an uptick in buying on the crude side. So when we're looking at our kind of prompt arrival windows, which are now late July and early August, we're seeing that actually 40s and other North Sea grades are pricing extremely competitively into the region, even versus typical local barrels coming either from South Asia or Murban, or even the big competitor grade coming out of the US in terms of WTI. So with the picture as it looks at the moment, as and when buying returns, it should be looking also to the North Sea or to WAF grades to pick up those barrels. But it does look as though there may be some hesitancy to return to buying just at the moment, as margins have softened at the edge. Looking forward though, and looking onto the next slide, it would be reticent at the moment to say that there is no demand indicators out there. The first thing that we see is the big the changes that we've seen in OSPs coming out of the Middle Eastern grades over the last couple of weeks or so. Those OSPs have been hiked quite significantly, and only really Basra Medium spot actually kind of trading above OSP levels still, pointing to essentially a market that is still able to and willing to pick up those OSP grades, those relatively tight market medium sour grades out of the Middle East. And essentially what these OSPs changes have done over the last couple of weeks is bring those grades into line with where the rest of the spot market is. So it is a relatively significant sign that at least those players in the Middle East, those OPEC producing countries, are not seeing or not foreseeing any kind of significant downturn in demand where they would need to be pricing more aggressively or more competitively into those markets. And on a delivered basis, and indeed also on a refined barrel basis, those grades remain relatively competitive. Into the east, maybe a similar kind of quality grade in terms of Johan Sverdrup, those margins are now in line with Basra Spot, which is trading above Basra Medium OSP, for example, and Arab Light, and that's despite the narrowing of the west to east differential, the EFS, over the last couple of weeks. So those Middle Eastern barrels are still looking competitive into the east. Into the west, it's a slightly different opportunity, slightly different picture. So into the west, those grades that are coming out of Saudi Arabia, Iraq, the UAE are no longer looking as competitive as they were a few weeks ago. And so the impression is that these barrels should be staying in the east now, which is going to give an additional floor now to the west of Suez markets, with that competition essentially removed in the short term at least. Finally, talking on the west of Suez and what's going on, everybody needs to know what's happening in WTI, for example. And actually the movements that have been taking place on the WTI complex over the last couple of weeks have really made that look quite uncompetitive at the moment, both into Northwest Europe, into the Med, into also then the West Coast India, and into the Far East. So WTI, it has its own dynamics at the moment in the prompt in terms of pipeline issues, moving from Cushing down to the Atlantic, down to the Gulf Coast. So there are some mitigating circumstances there. Crude intake in the Gulf Coast is obviously ramping up at the moment, so more of that WTI is staying where it's being produced, but it does still have this typical overhang for WTI, and the fact that it is currently the worst value crude into Europe and into West Coast India doesn't look great for its export opportunities within the Atlantic Basin. The picture does look a little bit better going into the Far East. It's moving into it. Obviously, it's now arriving. Kind of prompt would be first half of August arrivals, and WTI is competing favorably or kind of at a level playing field with those WAF and North Sea grades on a delivered basis. But on a margin basis, it is still seeing a little bit of a downside, just because of how product pricing is shaping up in the Far East at the moment. So that's all of it from my side. I'll invite James Noel-Beswick to talk about the middle distillate situation in the East and how that's being affected from the Atlantic Basin as well.
Yes, good afternoon. Thanks very much for that, Phil. It was really interesting. Singapore diesel, interestingly, has edged closer to backwardation in the prompt in recent weeks, signaling the start of a somewhat recovery. Adding to this, and noticed by our price reporter team who feed live prices into our platform, who are based in Singapore, South Korean diesel exports in June show signs that they will significantly decrease due to turnarounds and potential run cuts. A further part of this picture being that Singapore diesel cracks have dipped below their seasonal average for the first time since 2022. As such, reducing export margins have also led to early signs of reductions in May and June Chinese diesel exports. The Asia-Pacific turnaround period is currently at its peak and is expected to persist until mid-June. Furthermore, and as Phil discussed, Asian refineries grappling with these shrinking margins in the region have started to slowly turn to importing cheaper but lighter American crudes, US and Brazilian crudes, which should result in some reduced diesel output moving forward. Taking all into account, the outlook for Singapore, some about Asia-Pacific diesel pricing remains cautiously bullish moving forward. Moving on to the next slide, the movements of the Gasol east-west, of course, has a big effect on Singapore diesel arrivals, and therefore Singapore diesel cracks and spreads. Currently, and I think as a lot of us know, we observe a disparity between the ending of a turnaround period currently in Europe and the peak in turnaround period in Asia that we're going through currently. West Coast India ARBs, as you can monitor on our platform, continue to point to Singapore for June and July loaders. However, with Indian diesel demand currently very robust and therefore consequently reduced Indian diesel exports, there's an expectation and a necessity for the gas oil east-west to narrow further to also point to some AG arbitrage opportunities eastward. Moving on to the next slide, US crude runs and therefore diesel production have been relatively steady since the end of US turnarounds at the end of February towards mid-March. However, US diesel demand continues to face pretty much a lot of challenges, albeit showing some slight signs of recovery in recent weeks. Even today, there's been further notes about the Fed due to reduced inflation in the US, talking about rate cuts, but still tentative signs of US diesel demand recovering. Notably, ship tracking data reveals increased pull from US diesel from Latin America due to reduced diesel exports from Russia and, as we discussed earlier, Asia. While the outlook for summer US diesel pricing remains neutral to bearish, it's important, as we discussed earlier, to really monitor US diesel demand recovery and also what's become important of late, bio-substitution of that diesel demand. Moving on to the next slide, European diesel cracks and spreads have shown signs of stabilization, finding a floor in recent weeks, due in large part to the closed diesel arbs to Europe. As we discussed earlier, West Coast India and some AG arbs point east rather than west. And also despite the ending of the current turnaround period in Europe. However, the front spread remains firmly in contango. The widening trend of the HOGO throughout the year is important to note here as also. Given the significance of US diesel arbs into Europe post the Russian diesel sanctions, close attention must be paid to US and Latin diesel demand trends. Nevertheless, with the US Gulf TA arb diesel arbitrage to Europe mostly closed, although it did flash open at the beginning of the week, and AG West Coast India arbs, as we've discussed, continuing to point eastward, we maintain a neutral to bullish outlook for EU diesel into summer and Q3 2024. Monitoring diesel arrivals, arbitrage opportunities, EU stocks and demand levels through the Sparta platform will remain essential for making informed decision making. I'll now hand over to Samantha.
Thanks, James. Now having a look at gasoline, we first start with the global outlook. And in marked contrast to our first webinar, when we talked quite a bit about people in the market getting pulled up in the gasoline complex, we now face a complex that is in downturn. So global cracks and time spreads are softening for the summer as per our platform. Weakness in the European and US markets are filtering through to Asia as Mediterranean and European refineries begin returning from their maintenance, as well as we note, US gasoline demand is sputtering at the moment. There has been, as such, notable pullback in speculative length in these markets. That said, summer east-west spreads are attempting a rebound after falling to a year-to-date low in April. But what we see is that this will continue to challenge our opportunities along the curve. We do caution that there is overall downside possible in the near term before the summer driving season does kick in. Turning specifically to Asian gasoline, after peaking in May, Asian refinery turnarounds should be lower year on year through July. We do have more length coming into the market with the May Chinese export quotas, but we will note that the export will likely more lean towards gas oil rather than gasoline. And indeed, the Sparta platform is signaling ample gasoline length in the market with inbound Singapore shut through summer. That said, regional component pricing has been trying to put in a floor as several units remain down for maintenance in the region, but we've recently seen that decline amid tumbling Middle East components pricing. Although this morning there is an attempted recovery there as well. So are there green shoots for Asia? Yes, there are. So the softer AG complex has pointed those barrels westward, which has allowed Singapore barrels, as well as some Northeast Asian barrels, to become more competitive across the Pacific. Indeed, if you look at our platform, there's about a $1 to $2 per barrel difference between the cheapest barrels into either ends of the region, Pakistan to Australia specifically. And that's highlighting the supply competition that we've talked about. Singapore has also regained its status as the cheapest barrel into the east coast of New Mexico through summer. And this is important to note as fears of US Gulf Coast supply disruptions for hurricanes and late summer heat begins to permeate the Arbor complex. What could provide a floor for Asian gasoline prices going forward is that freight is quite firm. You do have increased ton mileage due to the Red Sea tensions, rising use of Cape of Good Hope, and that would require similarly firm delivered prices once summer driving season does indeed kick in, especially if it's prices to the upside, which is what Michael Ryan, my colleague, will deal with later. When we look at further demand green shoots, we do see that the demand data from the region's two largest economies, India and China, have shown record highs in March and April respectively. This is compared to the same periods in years past, which this could bode well for the upcoming holiday driving season. In India, the end of the Indian elections in June, which has thus far helped boost gasoline demand, should provide a higher baseline as the country goes into monsoon season, which is also its seasonal demand lull. The US, although the numbers for demand have been quite tepid of late, it has offset this by sending out a fair amount of exports. But again, we would note that there are some summer heat and hurricane fears starting to permeate the market very slowly. And that could definitely impact US refinery output, especially in midsummer towards Q3. I will note too that AAA has forecast a fairly record driving period for the US Memorial Day, which is at the end of this month. And that typically kicks off the US summer driving season. Why does this matter to Asia? If indeed those barrels stay local, you should expect to see shifting trade flows, which would then provide a floor to Asian gasoline in the coming months. That I will hand over to my colleague Jorge to talk about naphtha.
Thank you, Samantha. Hello, everyone, and welcome to this webinar. I'm Jorge, and now we are going to talk about our outlook for naphtha for the end of Q2 and also for Q3. First of all, I want to highlight the high volatility that we have seen since the beginning of Q2. At the right, you can find a chart with time spreads for Europe and Asia. Currently, we are in the middle of a very strong downtrend. And on the east-west side, it has worked the same way. It has tried sideways, mainly driven currently by the weaker Asian demand for petrochemicals and also by the lower environment on the gasoline side. The balance at this point suggests further drops. Middle East supply is going to remain steady. It started the year very low, but it has been increasing step by step. Currently, we are close to the average, and we expect these volumes to keep at these levels for the coming months. And the main bearish factor would be the Asian steam cracker turnarounds that will peak at the beginning of June, and also the LPG switch and seasonality. Further drops in gasoline could increase the downtrend in current naphtha market and impact the naphtha blending qualities if some qualities change from the blending pool to the steam cracker one. In this slide, I'm going to focus on the arc from Europe to Asia, which is the one that currently is open. We have been seeing it trading, and it's open in our tool for the last 10 days after 2 months. And the main driver has been lower European prices, mainly due to the lower demand for the petrochemical and for blending in Europe. Also, a slight recovery in the east-west and lower freight to the east has contributed to open this arc. And in the chart at the bottom, you can see the Middle East pricing. It has remained strong. It's trading lower this week, but it has remained strong for the last month. And this has increased the competitiveness of European barrels into Asia, since the physical prices in Europe have decreased and Middle East remains at the same level. Also, some product has arrived from the US to Europe, especially a couple of weeks ago, and this has had pressure to the European markets, allowing its product to go to the east. But we don't see that Asia will rely a lot on this arc, since the maintenance of the steam cracker will point to a lower naphtha demand on the short term. Now I'm going to talk a little bit about the gasoline market and its effect on the naphtha one. As Samantha has pointed, we are currently seeing a lower trend over the world for the gasoline market, and this is impacting, this is harming blending economics and impacting naphtha pricings. But we still see heavy prices in Europe, Asia, and Asia for heavy and LBM prices. So we see some downtrend potential for these blending qualities. And the same that we are seeing on the EVO and ARPOR, we are also seeing on the Singapore 92. One of the main factors behind this weakness on the gasoline market has been increasing stocks in US. Here you can see it on the chart at the right, and we are right now going close to the average. This has allowed US Gulf Coast to send cheaper light naphtha to Northwest Europe for blending purposes. But we see a floor in the gasoline market that Samantha has pointed, mainly driven by the peak on the summer driving season. And on this last slide, I'm just going to summarize our view for the naphtha market. In the chart, you can find the behavior for physical and paper prices in Asia, and also the Singapore MOPJ spread. Our view currently is neutral varies for the Asian complex, and the main reasons behind it are the steam cracker China rounds, beginning at the end of May, beginning of July, the LPG switching due to the seasonality, and also that the ARB is currently open from the west to the east. Currently is open from Europe, but there is room for some US cargoes to go into Asia as well. Also, the weaker currently market in the short term, if cracks and spreads keep falling, could also help naphtha to continue its current downtrend. And as I said, the steady Middle East supply and also the steady Russia, well, the increasing volume from Russia comparing to the April levels. On the upside risks, what that could cut this downtrend in the market right now are the weaker refinery margins, but we don't see this as a very big factor on the middle term. As my colleagues has pointed, we are seeing renewable strength in gasoline and distillates, so this will stimulate a little bit refinery margins. So we don't see that run cuts could be a very big factor. And the main risk for this, with a short position in the market currently, would be the summer gasoline season and the renewable strength for naphtha for blending. And now I'm going to pass the floor to my colleague Michael, who is going to talk about our freight outlook. Thank you.
Thank you, Jorge. Hi, everyone. Thanks for joining. So on the first slide, as my colleagues mentioned, there are signs of increasing CPP demand in Asia. The Ulsan to Singapore Disti ARB has been strengthening and approaching positive territory since bottoming in March. Naphtha ARBs from the Med to both Singapore and Yosu have strengthened significantly this month. Aliaga to Yosu on an LR1 in particular has increased and is $11 a ton in the money. These green shoots of demand will bolster sentiment and support freight rates. Alongside these signs of demand, Asian refinery maintenance peaked in early May. Refineries are starting to ramp up production again post-turnarounds. TC5, which is the most liquid proxy FFA for the Eastern market, and TC7 rates have increased alongside an increase in cargo requirements stemming out of the region. This is in conjunction with the positive freight market reaction to China clean product export quotas being up 7.2% year over year. The increase in product supply from the export quotas and the end of maintenance season implies an increase in cargo requirements in the coming months. The continued Cape of Good Hope routings to avoid the Red Sea are lengthening voyages and in effect reducing the supply of available vessels. This has provided an earnings floor for the east of Suez market that the west has not benefited much from. So with ARBs recovering, refinery maintenance ending, a bullish leaning set of China export quotas, and the floor provided by lengthened voyages, the Eastern CPP freight market is set to continue to perform well. On the next slide, on the other hand, with turnaround season ending, we should start to see a decrease in regional crude exports as refinery runs increase back to normal rates. We're also seeing a general decrease in Asia crude imports from the AG, and we're seeing an increase in US Gulf Coast and Brazil crude exports to Asia so far this year. TD3 out of the AG has performed well over the last month, while TD25 out of the US Gulf has recently weakened off the back of a lengthening vessel tonnage list. This trend of increasing US Gulf Coast crude exports to Asia relative to the AG, combined with increased Asian run rates, should lift US Gulf Aframax earnings if the position list gets absorbed in the near term. TD3 could see rates retrace lower alongside the shift in export region of choice to Asia. TD3 VLCC earnings are currently around 51K a day, while TD25 Aframax earnings are around 42K a day. I expect this DPP earnings gap between the East and West to narrow. On the next slide, US Gulf Coast MR rates saw a recent uptick in rates in part driven by the Houston to Rotterdam naphtha arb opening, absorbing several vessels. But now almost all Atlantic Basin CPP arbs are shut and position lists are lengthening. Ballasters from USAC are heading to the US Gulf Coast, providing some relief for TC2, but the west of Suez market is just not attractive currently relative to the earnings you can get in the east. Eastern CPP earnings are around 40K a day, and that's almost double that of either TC14 or TC2 in the west currently. Basis the lack of open arbs in the west and the overhang of vessel supply, rates should weaken from here, exacerbating the already large gap in east versus west earnings. Owners have been keen to lock in these 40 to 50K a day type earnings levels of late in the east, so potential breakouts out of this range have been tough to materialize. A clear out of prompt tonnage from a quick succession of cargo requirements could do the trick. On the next slide, so to summarize, east of Suez CPP is positioned well to continue to see outsized earnings and rates relative to west of Suez. There are positive supply and demand reasons, alongside turnaround season ending and the support of longer ton mile from Cape of Good Hope routings to be bullish the Eastern CPP freight market, while the Atlantic Basin is middling in the doldrums. A long TC5 or TC17 versus short TC14 trade could work well here. For DPP, there is a slow shift occurring with increased crude export volumes from the US Gulf Coast relative to the AG heading east. This combined with upcoming increased refinery runs in Asia could see a narrowing of the earnings gap between the East and the West. If you wait for the current lengthy US Gulf Coast Aframax vessel count to be absorbed, then a long TD25 versus short TD3 trade could play out well. Thanks for tuning in, and back to you, Sam.
Michael, I will invite all our commodity owners back on stage for the Q&A session. Just as a reminder, you can submit questions via the platform. A couple of housekeeping things to note before we launch into it. Attendees will be receiving a recording of this webinar along with the slides. So those should be in your inbox in a couple of hours. And one last thing that I see here, just another housekeeping. There's been a couple of questions asking about what we mean by Asian TAs or TARs. We say that a lot in-house. What we're talking about is the turnarounds or the maintenance that some of these Asian refineries and or steam crackers are undergoing. So with that, let's turn to the questions. There's a couple here. Phil, first one for you.
Yeah.
What are your views on the widening Dubai Brent differential?
Right. Okay. Well, yeah, this one is, as I mentioned, this Brent Dubai EFS has been narrowing or has narrowed quite significantly recently. I think the Atlantic Basin looks like it's probably found a floor now in terms of its relative value to the east. Those arbs are now open to the east, and so the relative course of direction now over the next couple of weeks at least, or a month or so, should be to see that Brent Dubai spread widening again as some of those arbs start to make their way, and just the relative supply and demand in the two regions kind of balances out so that the east is a little bit better supplied again.
Okay. What's your view on the West-East arb for naphtha in the coming months?
Yeah, currently, as I have shown in the PPT, the arb is open from Europe to Asia, and there will be potential opportunities from the US as well if naphtha keeps trading lower, especially on the light side. But we don't see it as a very big factor since, as I said, Middle East supply is going to remain at the same levels. Russian supply outlook is better than in April. So we see an increasing supply on the Asian side and potentially lower demand on the steam cracker turnarounds and also on the LPG side. So I don't think this will be a long-lived history. Currently, there are opportunities to send European product because the physical prices are very low. But we expect a correction or through freight or through East-West, mainly through physical prices in Asia that could prevent this product to keep going to the East.
I think this is one for the group. How do you see China's clean product exports this year versus last year? I mean, James, do you want to take that one, seeing as how we expect gas oil to be more gas oil send out?
Yeah, no problem. Yeah, what's interesting, they just introduced or announced the second quota of Chinese refined fuel exports, I think about a week ago, 2 weeks ago. So I think the first two for 2024 have been something like a 7% increase versus the first two 2023. So I guess overall, we're expecting, refined product exports to increase versus last year. I was speaking to one of our pricing analysts about it, and he thought part of the reason was that due to like a slightly struggling Chinese economy, that a way that they can kind of boost the economy is by extra exports. So I guess that's part of it. And I guess from a distillate perspective, we've seen very high exports from China at the beginning of the year. And the initial signs, I guess also from, we spoke about in my talk, are that reduced export margins. We should see a slight reduction in Chinese gas oil exports moving forward. So we've also started to see in the ship tracking as well. Thank you.
Yeah, I would just, if I may, add to that, so far crude demand isn't looking fantastic in China. And so just because the export quotas are there, it doesn't necessarily mean that they will be filled.
Well, Phil, since I have, you've got another one coming in for you. When do you expect heavy grade crude supply to come back to the market, and your outlook on the Saudi OSPs?
I think we're in for probably at least in the medium term to see a continuation of the tight medium and heavy sour, especially sour grades in the crude market. So Saudi OSPs, as I mentioned, have been quite bullish recently, and especially if the outcomes of the next OPEC meeting in a couple of weeks are either a continuation or even a slight increase in the cut quotas, then that can quite easily continue for those Saudi OSPs to remain at their relatively aggressive or bullish levels in terms of them not seeing a massive demand impact overall, and especially not for their type of crude. So the medium and heavy sour crudes are going to continue to be in really strong demand, and they can therefore afford to keep those OSPs at a quite high level.
Thank you. I guess I'll take this one. Saw on your weekly naphtha market commentary about pro-nap narrowing in Asia. How does that impact your mildly constructive view for Asian naphtha? So that is correct. We've seen the pro-nap swaps in Asia narrow for summer. This is largely been a function of Asian naphtha kind of crumbling of late. And meanwhile, propane has been on the rise as Chinese PDH units have come out of maintenance and bought up some of those cargoes. It is unseasonably tight. You can actually go to our platform and take a look at that. But I think what's going to happen over the next couple of weeks is you're going to see pro-naps kind of widen out again to more seasonal norms. there's a general expectation that PDH operating rates will remain fairly subdued. We run a forward margins in the background, and it does look like those margins for PDH units in China aren't that great. So what's happening in Asia right now, as what he spoke about in the NAFTA section, is that you do have the LPG seasonal demand. LPG will continue to be the feedstock of choice in Asian steam crackers. So that does mean that Asia will have to price itself competitively to remain in the steam cracking pool. All right, let's take a look at the next one. James, maybe one for you. What is the latest you have heard on Dangote?
Yeah, not a huge amount. So I think it was a few weeks ago, maybe a few months ago, that we saw some naphtha issued for tender. We saw some very high sulfur gas oil issued for tender. And in terms of tenders, I've not personally heard a lot since then. We have as part of our platform, we have live prices fed in from brokers for West Africa. And speaking to them, the kind of real effect they're seeing only is kind of less demand from Nigeria region, because more of internal Nigerian demand is taken from Dangote, but none of it actually released onto the international market in large numbers yet. I guess it's also important to note that they've hired a head of product trading for Dangote products trading. So I guess they have the impression that significant volumes are going to come onto the international market soon. But when, I don't know exactly.
James, actually, if I can ask you still. Sorry, go ahead, Phil. No.
I was just going to add from the crude side that latest reports show that there is a significant amount of WTI sat off the coast waiting for payment before it can be taken into Dangote. So it looks as though there are still some teething issues to begin with.
James, while I still have you, there's another one here for you. That's what's your view on diesel cracks, given more supply is expected to flow from the Middle East to Asia?
Yeah, so I guess my general view about Singapore diesel cracks, well, this is also about general diesel cracks, but I guess they're referring to Asian diesel cracks, is that they can't, I guess I'm bullish about kind of all Singapore-based diesel pricing currently, mostly based around kind of peaking turnarounds currently, which is resulting in, as we've spoken about, reduced South Korean exports, which is a major supply point into that region, as well as some reduction in Chinese diesel exports as well. But it is indeed that if I expect that the gas oil east-west narrows and we get more supply for the Middle East, that's gonna provide some kind of ceiling to it at some point. I don't think we're at that ceiling yet.
I haven't forgotten about you. Here's one for freight. Do you see the Cape of Good Hope impact on rates lasting?
Thanks. So in short, yes, as long as there's turmoil in the Red Sea, the risk reward for the big ship owners and the big trading houses just isn't there to route their ships via the Suez. There are smaller ships that are taking advantage of the situation and trying to gain some market share. But again, the risk reward isn't really there for the bigger guys. And the incentive, it sounds kind of bad to say this, but because of the rates, they're enjoying higher rates because of all of these issues and the routings around the Cape of Good Hope. This has put in an earnings floor over the last several months. And whenever we've seen some of the liquid Eastern FFA routes sell off, they kind of bounce above a floor that is higher than what it was before the Red Sea tensions. So the incentive just isn't there for the big owners to take the risk to go back through the Red Sea and through the Suez at the moment.
Okay. I think this one is for me. You've mentioned fears about the US Gulf Coast refinery disruptions. Could you elaborate on how summer heat hurricanes have affected US Gulf Coast gas in the past? How does that pertain to Asia, given the US Gulf Coast is not a major gasoline exporter to the region? Sitting here in Houston, it is already extremely hot. These refineries do not run well in the heat. We have something rather delightful called rolling brownouts, where when the grid can't take the demand for electricity, it shuts off certain pockets. We have power trips all the time. So you'll see that if you look at the EIA data during summertime, you get a definite dip during periods when we have tremendous heat, usually July, August. Now, how does that affect? Well, obviously with refinery shipping offline, depending on how long those disruptions last, those offline events, that could be majorly or not impactful upon refinery output. What is more concerning is the hurricane and the effect on that. And again, it's a question of where it hits. We've already seen several fairly reputable agencies come up with rather terrifying forecasts for the hurricane season. So where this does impact is if it's a hit on the Gulf Coast, if it's a hit on land, specifically around the Gulf Coast, around Houston, which is where I sit right now, Louisiana area, flooding and power outages. The worst of it is the flooding, because that has taken down a fair amount of refineries in the past for long periods of time, months in effect. So that would be a major impact on refinery output in general. How would that affect Asia? It would just be shifting trade flows. If we're short here, those trade flows would have to shift in order to meet demand as and where it occurs. Especially again, hurricane season is could hit in the peak of summer driving season. We've had our fair share in August. So that's never a good sign.
And if I can just, sorry, I know I'm kind of jumping in on the end of a lot of these questions. If I would just add that last summer in particular, which was, and also the year before, which were quite hot in Europe as well through the summer, we saw that some of the biggest kind of common impact on refinery run rates in the summer was heat waves in Europe as well. So it's typically has been an issue for the US Gulf Coast. I think more and more we're going to see that become an issue also in Europe as well, where especially the Mediterranean refineries have been struggling to reach full utilization through the summer, just because there are kind of expansion issues when you're running your refineries at higher ambient temperatures, which they are not designed to deal with. So that can quite easily take 5% off of run rates. That's quite a significant impact.
Yeah, I was thinking exactly the same. We saw big effects, as you said, in the Med due to heat issues, and I guess that's things about climate change. I guess that's probably something that's an issue here to stay for a while. So I guess also important to note is I think 2023 and 2024 are predicted to be El Nino years as well. So also heightened temperatures in the summer. So something to be aware of.
James, while I have you, Europe received almost record levels of diesel imports in April. What are some of the reasons behind this?
Yeah, well, it's actually interesting. Jorge was actually quoted, I think, in a newspaper talking about this. But so we saw, because of the issues around Israel-Hamas, we saw peaking and reduced supply through the Suez to Europe. We saw peaking European diesel cracks or global diesel cracks around February, March. That incentivized Middle East refiners to start producing large amounts of diesel. Also, those issues also created a real strengthening of European diesel over Singapore diesel. Therefore, the East-West really blew out and widened. So those factors, and also the market, the freight market adjusted to having go around the Cape rather than through the Suez. All of those kind of factors added together to send record amounts of Middle Eastern diesel to Europe, as well as what we've seen as well is that the HOGO has been widening all year in order to open that US Gulf transatlantic arb to Europe as well. So it's the addition of extra Middle Eastern supply as well as large US Gulf supply to Europe as well. Thanks.
Yeah, just one point on this question. We have seen it on our apps comparison, looking at the delivery prices and the margins from AG and Red Sea to Europe and to Asia. The market was very strong on the diesel side 2 months ago, and for the beginning of the year, and we saw better economics for the aging barrels into Europe compared to landing into Asia. And after the turnarounds in AG, this has driven to increase in supply from AG that has been placed in Europe, taking us to these record levels.
Phil, one more for you. When do you expect European crude demand to return?
If it hasn't yet, then frankly, there's not a lot of incentive at the moment for it for incremental barrels to be brought up and refined. Gasoline outlets we've seen for Europe are not great, so there's not really a call at the moment for additional runs at the margin on gasoline. And as we just mentioned, diesel imports into Europe have been pretty staggering through April. All those arbs are now closed, and maybe the situation looks better in June. But at the moment, there isn't really that particular call for additional kind of that extra couple of percentage of utilization at the refineries which are running. So cautiously, I think we said on the diesel side, we're cautiously optimistic that the diesel market can turn around in June, maybe second half of June. So the answer would be by then. But certainly in the short term, we're kind of, I think, already at levels which are representative of just where the economics are at the moment.
We've got still a ton of questions, but it looks like we've run out of time. So apologies to those of you who might have submitted some questions. Please feel free to reach out to us directly, and we're happy to continue the discussion. Thank you all for your kind attention and attendance today. As I said earlier, a recording of this webinar will be made available to you shortly. So please look out for the link in your email inboxes and on social media. If you are new to Sparta and would like a demo of our platform, please email us at sales@spartacommodities.com or visit our website, www.spartacommodities.com. You are an existing client. Thank you for your business. You'd like to check out any of the other services you do not currently have access to in the platform. Again, we'd be more than happy to walk you through these. Email us at sales@spartacommodities.com or visit our website. Before we go, we'd like to invite you to attend Sparta's first anniversary celebration in Singapore on May 30th. Details on this event can be found on our website. Once again, thank you for joining us and have a great rest of your day.